That's not the case, and because CCPS holders may enjoy additional rights and preferences, the value of CCPS or any other investor class could be different than the generic equity share or ESOP for that matter. So in this case, what we do is you take the share price of CCPS and then backwards calculate to arrive at the price of ESOP. So without going too much into technicality, conceptually, you have the CCPS price and make all adjustments what is required to adjust for the difference between the CCPS and the, let's say, an equity or ESOP equity. It could be liquidity adjustments because CCPS shares could be having tag along and drag along rights. So liquidity is much better than the ESOP holders. Or it could be the economic rights itself with liquidation preference, which CCPS holders would enjoy. They would have better economic return possibility. So that also needs to be adjusted to arrive at ESOPs. So this overall process is called backsolve. And in this, we have option pricing model could be used to as one of the steps to arrive at the ESOP valuation.
Thanks for that. If there's any question, we'll take it on. But otherwise, let's move on to the next question, Shilpa.
Yeah. Sheetal, you have a query, you can raise it, no problem, because it is related to this point only.
Yeah.
Okay, I read the query in the chat box.
Am I audible now?
Yes, Sheetal.
Yeah. So thank you, Shilpa. Since it is related to this question only, just want to raise it now. So this backsolve method should be used even when we are getting, suppose the company has already issued ESOPs and they have the preserves for ESOPs, and also one time they have issued CCPS. So the next time when they are trying to issue CCPS in the second round, should we use this backsolve method?
Okay, backsolve can be used at any point of time or for any instrument. However, it will be more suitable and relevant in case if you think that whatever is the target transaction which you are using from the final value, from that point in time to today, there has not been much changes in the company or the business environment or generally the economic scenario or the industry ecosystem. If not too many things have changed, then we can use it. For instance, let's say 3 months ago we have used this, and after that there is some significant development in, let's say, EV, or in case of technology it could be some blockchain movement or anything. So anything has grossly changed, or maybe the company has entered into a few contracts with certain key customers between the periods, which will really change the outlook of the company. When such things are not involved and really comparable scenarios are there, then we can use this method.
So is it 3 months only or 6 months?
Yeah, so it's more or less like an internal cup method only. So there is no exact time period. As I said, as long as we believe that the outlook for the company has not changed between the two periods, has not drastically changed between the two periods, it can be used. Even 1 month also nowadays leads to a lot of changes, or even in 6 months there may not be much changes. So as long as we feel that the outlook of the company and the ecosystem has not much changed between the two between the target transaction date and the current valuation date, this can be used.
Okay. Thank you.
So let me just add on, if with your permission, Chinmay.
Sure.
See, if we look at, let us say, a 50 crore valuation at which round 1 CCPS is issued, they will never convert in case the value is less than 50 crores. However, when you do a round 2 valuation, which is, let us say, at 100 crores, you can more or less assume that the 50 crore round will definitely convert because they have a valuation which is far higher. Then if you have a further round at, let us say, 200 crores, then you can assume that both the 50 crore and the 100 crore round of CCPS would have potentially converted into equity. So basically, you're getting, through the backsolve method, you're getting back to the point at which you find that the CCPS would convert to an equity because of the advantages of converting to equity. So when you're doing a valuation, let us say at 200, if people have not converted, for example, you're trying to find out what is the allocation of the values between the 3 rounds of CCPS. And when you do this, you know that there is potentially a value to the option. So you have to allocate a value to the option for each CCPS as well, because they have the right to convert or not to convert. If this is my limited way of trying to explain something which is a little bit more complex. I hope that you're okay with that, Chinmay.
Yes, certainly.
So do we need to do this exercise every time whenever the valuation for the equity shares is asked for the allotment or the issue of new CCPS in the second round?
Yeah, Sheetal, so this can be used whenever we have one class of instrument value clear and the other class of instrument we need to determine. So when we have one instrument, but we want to know some other instrument's value of the same company. In that scenario, it can be used. It can be fresh issue, transfer, any scenario it could be. In general, we know one class of shares, we want to know some other class of shares. In that way, it is useful.
That means to say, for example, presently CCPS are being issued. Already equity valuation was issued some other time, long back. So now when a present purpose of issue is CCPS, as a registered valuer under compliance of section 62, will I arrive at fair value of equity share or, fair value of CCP? Because now I don't have any fair value of CCPS as such.
Yeah, specifically in the facts like what you mentioned, Vaxol may not be useful. If some period very long ago, if we have issued equity shares, it may not be too relevant. Or we need to see the facts of the case, but generally it may not be too relevant. This would be useful. Most of the cases, like as I gave the example, there is one round of investment which has happened recently, and for some other reason we are finding the valuation, maybe for accounting disclosure perspective or for computation of expense perspective or any reason if we are calculating. In those scenarios, it will be more useful.
Was any time any preference shareholder approached you that I am a CCPS holder, I want to sell it, so can you try to help me valuing my CCPS using these methods?
Generally, we don't get requests for a particular methodology. It will just be for determination of fair value, either fair value or valuation as per any laws. For example, for FEMA or for Companies Act or something, or for just generally to know the fair value as to, as you said, I want to sell off, what is the fair value of my shares, or I want to buy that company, what is the fair value of that company, like that. But particularly methodology, it's the valuer's choice. We need to decide what is more appropriate in the given circumstances.
Can you take up chat questions on this relevant, or shall I raise it?
No, I can say, is this suitable for fresh issue? We already answered. It's nothing to do about an issue or what is a transaction. It's to do about, do we have a comparable transaction internally, which can be compared with the current valuation scenario. Next one is, can we mention this method is used in the valuation report? Yes, it can be mentioned. See, again, practically speaking, for instance, if we are filing with, at least I have done this for FEMA purposes, income tax purposes, and Companies Act purposes. All the methods, all the scenarios we have used this. But however, having said this, if you feel that there are other ways to derive value, for instance, other ways in the sense, even though practically I've taken a call, let's not go with backsolve when there is a possibility of resolution through a normal, just a DCF methodology. For instance, for RBI filing, you may really, whatever is the cap and floor price is relevant and not really the exact valuation price. So in that, I mean, my preference would be, though technically it may not be the best, my preference would be to use just a simple DCF value, keep the valuation report simple, so that it is filed and everybody, you're used to seeing DCF. If a RBI official or an AD banker or a tax authority, they're used to seeing the projections, they're used to seeing the cost of capital. They will have their ready questions. How did you find out and all? We should have our ready answers, which database and where we took the data from, and then use that. But so in some scenarios, it may not be useful. For instance, you may not be able to, let's say, the client may not be able to give a reliable projections, or they may not be able to explain the model in a very clear numerical things, what all questions we would have for backing up with their projections. In such scenarios, this could be a very useful tool where you don't have either explanations or time in really going through the complete detailing. Then you could take the comparable, which is having in this case, and then use backsolve to arrive at the target valuation. So otherwise, it's always preferable to just use the normal methodologies, especially for when you're doing it for a regulatory valuation. But when it is not possible, definitely this is a good way. And as I said, we have used this in many scenarios. In one of the case, very clearly, I remember there, we had to make a distinction between two class of shares because where FEMA, Income Tax, Companies Act, all three regulations were applicable for the same transaction, where you have an allotment for residents as well as non-residents. And there are some people who are transferring the shares also in the all three in the same transaction. This is very normal. Whenever there is an exit event for a company, the existing shareholders, the new shareholders may agree to buy the existing shareholders a part of it, and they will also invest further capital. And there could be some local Indian as well as foreign shareholders. So in such scenario, all three possibilities would be there. And generally, secondary transactions would happen at a slightly lower price than the primary transaction. I mean, fresh infusion will happen at a slightly higher price than a secondary transfers. So at these situations, you may need to derive different values for different class of instruments, and the fair value also is different. In fact, not that we need to adjust the different price, fair value also would be different, because let's say the latest class of instrument would have 1:2 liquidation preference, and the one earlier class of instrument, let's say it will have 1:1 liquidation preference. So actually the 1:1 class of preference shares would have lower value than 1:2 class of preference shares for sure. So in such cases, this is the only method which is possible, and no other method like simple DCF or any other method, market multiple, whatever method we use, still we need Backsol to trace it back and differentiate between the different instruments. So this could be a classic example where Backsol could be useful.
Sir, I have a question. This is Vaidyanathan.
Hello, sir.
Sir, the question is, are you sure IVS allows valuation method other than the three prescribed approaches or methods? That's my first question.
Okay, so three approaches are mentioned. We need to either follow whichever approach is more suitable in a current scenario, but methodologies is always open. Which method we use to, which type of method we use to value is always open. Approaches, we need to be clear whether we're using income approach or cost approach or market approach. So this will...
I'll give an example. So I had a case where I have to value equity shares, and there were OC optionally convertible redeemable preference shares. What I did, I calculated the enterprise value, reduced debt, then arrived at the fair value of optionally convertible redeemable preference shares, then said this is the fair value of the equity share. Okay.
Sure.
Now, this aspect, I'm introducing the fair value of OC RPS is basically based on the coupon rate, which will get adjusted for the discounted rate. Now the question was, does IVS allow such interpretation? Because IVS, to my understanding, you cannot use any other approaches or methods other than what is being prescribed under the three income, market, and the asset approach.
Okay, got it, sir. I got your question. See, firstly, Backsol is not a method of valuation, or Backsol itself is not an approach of valuation. Backsol is a terminology which is used to cover a scenario where we are using some transaction and back solving to arrive at our instrument value. That's about it. That's not a methodology in itself. So as I told, it's an internal comparable methodology. Yeah.
So I think that we will just, in the interest of time, maybe we'll just move on, because this question on OCPS is also covered later. So Chinmay, I think that your point is...
The issue is not OCPS. For example, I use a Berkus method. Does Berkus method is a possible acceptable approach under IVS? The question is on that, not on OCPS.
So I think, Mr. Vaidyanathan, basically what Chinmay is differentiating is there are three approaches. Within the approaches, there are methods. And Berkus method can be used, but what Chinmay has told you is that normally people prefer to see the DCF method. You can probably use the Berkus method to say that we are getting to the same value by doing a reconciliation of values. That's possible. So OCPS, however, let's come to that. That's a very interesting question. We'll come to that in a bit. Let me just ask, in the meantime, before that, let me ask Vikas Suresh, Vikas, what do you
We
think of the question which was
just
raised?
to specifically answer this Berkus, because we had Berkus method. I think Berkus method using would be a little difficult to justify that it is an income approach. So you may find difficulty in justifying Berkus method to an income approach, because it's really an arbitrary allocation of percentage of your
Correct.
assumption of valuation. So you may find little difficulty, but always valuation is a very creative exercise. We need to see in what ways we can do it, but at the outset it may become little difficulty in justifying that under the income approach concept. So having said that, in your IVS question, see, in case if it's a regulatory filing, then you may need to really justify income approach and Berkus method.
It doesn't matter. So it doesn't matter with the regulatory or otherwise. The fact here is, now what I do, I make the engagement term as per ICAI valuation standard, because that I know that allows.
Yeah. Exactly.
I don't know whether I'm doing right or wrong, but I ask my client to make the engagement terms to be as per ICAI RVO valuation standard. And
no, I think engagement term should be very clear. If it is not for a regulatory reason, engagement term should be just determination of fair value without reference to any standards at all. We independently should determine the fair value based on what is the best method we feel. And IVS or Indian accounting standards could be a reference pointers for us to, if at all we need any backing, for us to reference point, that's all. Otherwise, we should be independent to do the valuation in the method which we feel it is appropriate.
No, I'm not talking about the method, I'm talking about the standards. So I ask them to have an engagement term, do this valuation as per ICAI RVO valuation standards. No method approach. No, that is not part of engagement terms at the standards level.
Yes, sir. That's what I'm saying. In an engagement, you should not have standards. It should be a fair value determination. That's all.
But then how do you define what is fair value unless you introduce a standard and put that definition of that standard in the engagement terms? So because fair value is not a concept in IVS, it uses the term market value. So you can't have engagement term determine fair value and you have a report on IVS saying that I've gotten market value.
Yeah, maybe.
Chinmay, can I just step in so that in the interest of moving on to the other topics, because the other speakers are also wanting to discuss about this. I think that let me just ask Vikas Suresh to just step in for a moment and give us the viewpoint on the standards as to what are the standards which could be potentially used and the methods which could be used under those approaches and methods which could be used to your in your experience, because Chinmay will come back to you with the other questions. Yeah.
Sure. Thank you, Abraham. Good morning, everyone. I think again, formally thanks to the team to invite me in this. And quickly on the topic which is being discussed right now and the standards, maybe we are trying to mix up between the approaches to valuation and the computation mechanism. When we have, in my limited experience, when you have more than one series of shares, say for example, in the given situation, let me say, for example, if Baiju is being valued, let's put some case so we can understand that better. If Baiju may have up to series F of funding, A, B, C, D, E, F. So when you are valuing Baiju today, and you have to know what is the value of equity shares or the common equity shares of Baiju. So first, and each of these series of shares will have their own rights and their floor and caps in their valuation. You have to go through the agreement for that. So when you do that, all you have to do is, when you are finding out the value of common equity, so you have to allocate the valuation based on the rights available in different series of shares. Backsolve is only a method to say if the current transaction has happened at a particular valuation, which means what is the value allocable to others. It is only solving backwards to say if this is the current valuation, then how, when I go backwards and solve it and say for series F, if this is the valuation, then A, B, C, D, E, what would be the valuation? Hence, what comes to common equity. It's only a way of allocating and getting back to common equity. We are not deviating from any standards of valuation to say that could still follow that, you are doing a DCF, and after DCF there are some derivatives because of the rights attached to particular series of shares. So for example, in series A, it may say that I will have a common equity plus I will have a preferential voting right, or some commercial right to that extent that I will have a preferential dividend right. Like the series B may have common equity plus the preference dividend plus differential voting power. to that extent, each of the classes may have different rights attached to it. So when you work backwards and say, if today's valuation is Series F share is say 1,000 rupees per share, so what does it translate to equity? That is all we are trying to achieve through backsolve. So you will still follow your DCF, you will still follow your approaches, whichever you mentioned in the valuation standards. We are not deviating from that at all. So I hope, Abraham, I was able to.
Yeah, I think that addresses adequately. In the related matter, let me just then, Shilpa, with your permission, let me just ask GaneshRemani to throw some light then on what are the methods of valuation, because he had raised the Vikas method as being a method which he's using for valuation. We can ask Ganesh, is there any other method which potentially we could use other than DCF, which will make sense in the valuation report? In your experience, sir, what do you think is a good method to use outside of, let us say, the DCF method for valuing a startup or for a matured company?
Thank you, Abraham. Thanks, everyone. If I were to seriously look at a matured company, I would go typically both DCF and the market multiple, because matured companies typically look at comparables, how people are considering this particular sector and what should be the basis I have to value about it. Startups have completely different thought process. I think many a times I have talked about in the group itself, so that I'll come later. So I was involved in one of the, since you're asking specifically the experience, mortgage finance company where I was doing the valuation. I did the intrinsic value of the company and the market multiple of the company. There was a huge difference in the value that we received. And this is for a internationally, it's a large $1 billion asset company. So when we had two different huge valuations with two different multiples, then it's not simple that one has to take a weights for each of this, which I definitely don't take it. But that's one of the questions. I believe that everyone has this question of what should be the weights. You should go back to the purpose who is going to acquire about it. Every valuation starts with someone saying that I need a value. So start with that. The value that you derive is for that particular investor, for that particular purpose. So if I am the acquirer and I am looking for a particular purpose, my expected returns will be the determining factor for my valuation. Market multiples inherently assumes it's a price discovery mechanism of how the market perceives the current management, the current corporate governance, and the performance of that particular sector. So if you are trying to directly average out market multiples for your valuation, there will be a challenge unless you feel that it is in sync with many other industry peers. So this particular example, what I took in mortgage finance company, a lot of the variation in the industry multiple is from say 1 price to book to 4 price to book. How does one take that as a reference point when you're doing the valuation? And we are trying to value an unlisted mortgage company. So here we have not considered market multiple, despite mortgage sector being there. We looked at the inherent DCF only and not the market multiple. So matured company, when you do, I would look at both DCF and market multiple. If they are reasonably close and consistent in the numbers and the values, then I would take the averages of both, no matter. But if there's a large difference in the values that I get it, I would go where the values look more reasonable and sustainable in terms of projections. So I have considered DCF and not market multiple in the mortgage finance company.
Right. So let me just address one of the points which you had raised then, Mr. Ganesh. See, the thing is that suppose, let us say the values are more or less similar, okay, under the two approaches. Would you then say that, okay, I will give a 60% weightage to one and 40% weightage to the other? This is phrasing the same question in a slightly different manner.
Yeah.
So,
yeah. If the variations are not far away, then I would go for market multiple than a DCF. Because
right. But then, sir, how do you decide that 60% versus, let us say, 50%? That I think is the question which almost everybody has.
See, you should understand two things here. Suppose I could have the DCF captures a lot of inherent assumptions of a particular, valuer or a, acquirer or, a target company or the person who is selling it. Market multiples is actually the inherent assumptions of across people. There is a price discovery. So no matter, you could have whatever best assumptions you could have it, the market multiple, actually market is going to perceive only this. That's what is the market multiple. So if I were to say that between the two, I would just go higher weightage to market multiple 60 or 70 or 80, because that is giving me a trend. So since I'll take this further so that you get a perspective here. Market multiple not only captures the assumptions of the growth of the company, but it also captures, one, the inherent leadership. Two, it captures corporate governance. Three, it captures the sensitivities of other sectors. All these are determined in the market multiple. That's the fundamental aspect of market multiple. So I may be gung-ho about the sector. I may be very optimistic of the growth, whatever I could be doing, but market doesn't perceive it. So when I am looking at acquiring something, I would say look at the market as a basis. On that basis, I will do it. Why, when I don't consider market multiple, is when there's a huge difference. Then I say that there is no sanity in the price discovery, so let me not even consider. Then I will give a significant weightage. And the weightages, as you said, 60 or 70, depends on this parameter.
Okay, that's a good answer to that. Shilpa, can we move on to the next question?
Yeah. How would you take up, brand valuation of Zomato and Paytm? What are the approaches? What are the parameters on which these two brands can be valued?
Okay, I think this is a good question for Vikas, because he has done quite a few of these.
Sure, thank you.
Then we'll ask Chinmay to chip in. Yeah.
Thank you. So when we are looking at a brand value of any company, as in we are talking of Zomato and Paytm, so we are talking of, if a typical brand should give an economic benefit to the user. So if they did not have a brand, they would have taken it on royalty basis from third parties. So the primary approach which I would take in case of any brand valuation is to say what anybody would pay me as a royalty. So say a typical food companies, if you're talking of, if it didn't have this brand, so maybe you say today McDonald's is a brand which offers franchisee. So you may want to refer that what is a royalty fee or franchise fee which McDonald's will take. And when you do that, I might have to just study the constituents of the franchise fee here, because the franchise fee may come with brand and other components also. So when I attribute the weights what are to the brand, that is the kind of royalty a person would have paid for getting a brand of similar type, for borrowing a brand. So if Paytm or Zomato has created its own brand, which means it is saving the royalty which it would have otherwise paid. So I would value Zomato, Paytm as a savings of royalty of what they would have otherwise paid. One method, and then corroborate that with any kind of transactions which have happened in the food sector, saying that typically the transaction with only brand have happened at 2 times multiple, 1 time multiple of revenue. So I would also corroborate it with that. I think they would be the two key methods if I have to value the brand on a standalone basis. Only one place I would just further like to add is that if the brand is being valued, as if you have a comprehensive exercise to be done where you want to get a more detailed answer for that, so then we first value the business of the company, and that business of the company gets allocated to various tangible assets and intangible assets. At that point of time, we attribute, then there is a typical purchase price allocation approach which we follow. And there we say that if the total profits of the company was X, and from that profit, I remove the charges to various other assets, because the company is getting set to a 15% profit because it has assets, because it has, other than brand, it has some technology platform, it has some IPs. So I will remove the profitability for all of that, and the remaining profit is what we call as the excess profit. So the excess profit over a long-term period of time when discounted to present value gives you the value of its brand. So royalty methods are just put together.
Let me then just chip in and ask Chinmay also to corroborate now. See, let me give you an example. In a restaurant business, let us say we have quite a few businesses in Bangalore itself where you have a chain of restaurants. Now, typically, when you're doing the valuation of the entire business, let us say it is 800 crore valuation. Now, you know that the business can be, there is certain values which need to be attributed to, let us say, uh, the assembled workforce, the methodology used in preparing food, etc. All of that is there. But the bulk of the value, strictly speaking, should come based upon the brand. That is the attraction of the customer to go to a certain restaurant. So in your experience, Chinmay, the question is, how much typically of the value of the enterprise goes towards the brand? Will it be 30%, 50%? Or how do you get to this number if you're doing a brand valuation? You're mute. You're on mute.
You're on mute.
Yeah, allocating a percentage is really impossible. Having said that, see, specifically if the question is about the way it started with Paytm, Zomato. So if it is about the companies which have not started its positive cash flows, then really there should not be much, in my view, there should not be much brand value at all, because brand value you can claim only once you can generate revenue. Otherwise, it will become very arbitrary calculations, but there could be some use cases where you need to do it, you need to identify and how the arbitrariness can be avoided. But in general, it will be very difficult or may not necessitated to really create a brand valuation alone. Enterprise value, there would be very much clear. It will be there. For example, Zomato, it will claim a very good enterprise value, but just as a brand of Zomato, assigning a value could be very challenging. And coming back to the restaurant example, see, the conceptually, let's say to understand it a little better, let's say in the same street, we have this one restaurant in, let's say, Southern Circle, where I'm just sitting now, in Southern Circle, Padalama Street. One in the beginning, there is one restaurant, and opposite to that, there is one more restaurant. And one is, let's say, Adidas, which has some brand value. The other one doesn't have any brand value. And if you assume that both of them give the same quality of food and same kind of offering, same kind of service, and everything is same, still, if there will be more footfall to Adidas, then there is brand value. But if that is not there, then there is no brand value. So in the same example, okay, possibly Adidas is a not right example in the current scenario. Let's say 6 years ago, when Adidas was there, when really people, there was a group of people or class of segment which used to think that, okay, Adidas means at least basic quality is ensured, basic sanity is there, hygiene is there, and we don't need to too much worry about what ingredients used, and we go. So there could have been more footfall, even though the same quality is given in the opposite restaurant. So that is what brand value is all about. It's about the recall value. It's about that. So in such a scenario, there will be more turnover in Adidas for the same expenditure what other restaurant incurs, and that's how it gets derived.
Sorry,
Right. So
sorry,
Vikas,
may I, Abraham?
please, Vikas.
Sure. So maybe I have a little different view here from what Chinmay said, and maybe I'll share that. See, a profit negative necessarily doesn't mean that there is no brand value, because profit negative, just for example, if you look at Coke and Pepsi, when they entered India for 15-20 years, they were incurring losses. And that doesn't mean Coke or Pepsi does not have a brand value. Profit is a function of brand profits plus operational investments, because Amazon has been running on negative profits for now multiple decades. So the profits which they are getting, I agree with Chinmay on the point that if you have a brand, you have to ensure that there is economic benefits. That benefits, which means that on a unitary basis, you can check that if compared to another restaurant, if I'm going to, like how you gave an Adidas example, let me take another example saying that if I go to McDonald's versus another burger shop, so if I'm ready to pay a 20 rupees premium to McDonald's on a unitary basis, it has a brand profit. So which means there is a brand value attached to that, because either on the profit side or on the realization pricing side, I'm giving a premium there. So I will say that there is a brand value. Now that gets offset because they are putting in more number of people expanding, and they are putting in operational cost for the more people for that. So that is getting offset. Hence, that is where I said that if you have this situation, you can still take a royalty approach and value the brand, because that doesn't require a profit.
So let me just ask this again, Vikas, because I was trying to bring the question back to Paytm and Zomato in course by using the restaurant example. See, when we did one assignment, we just found out that typically in the brand value constitutes, let us say, 30% of the value of the entire restaurant. Okay, that was the allocation across multiple restaurants. Okay, multiple restaurant businesses. So this, when you look at it, now logically seems to be that, okay, the reason why people go there is because of the brand. They are expecting something, and therefore the value of the business, when you look at the overall enterprise value, 30% of it is due to the attraction which people are having for that particular brand.
Sure.
Now, when you look at this in the context of Paytm and Zomato, is this a methodology which you can actually use, that is in general about 30% of the value of restaurants is, and is it something which can be similarly attributed to a Paytm and Zomato? 30% of the enterprise value is potentially because of the brand value, is
Very
what
good.
I was just trying to get to.
Very good perspective, Abraham here. Just to share my experience on that. See, we can't fix a percentage to a brand value for any business and extend that to all. Within the restaurant business, if you say, or within the Paytm, Zomato business, if you're saying, there would be companies which have 5%, 10% attribution to brand, because they wouldn't have created that level of a pull from the market. See, brand again has a strength score. If you ask the marketing guy, because this is a combination of a marketing asset as well as a commercial asset. If you ask a marketing guy, he will tell you the brand is measured by a score. There is a brand strength score we have. And based on that, within the Paytm industry, within the fintech industry, Paytm itself will have a ranking. So if Paytm is having 30%, there could be players who are also having, if you go to ICICI, if you go to HDFC, may actually have 40-50% coming in from the brand value. And similarly, there would be players who are just new entrants. They will maybe have 5-10% of the brand value. So brand value is a subjective term where how much of pull it can create from the market. So you can't fix a percentage of 30, 40, 50%. And in my study, if you look at, globally, there is this Interbrand which publishes a study on brand valuations. And when we try to assess that, what could be the brand value as a proportion to business value of companies, we saw from 5% to 75% of a business's value comes from brand, can come from brand. So if you are a consumer industry, clearly that the business is driven more by your presence in the market, your visibility in the market. There I have seen higher percentages, more than 40-50% coming in from brand. Whereas if I am more on the institutional or the B2B side, my trade name, brand name becomes a little lower end. So it can be a range. It can't be a number which can be fit to all the restaurants.
Okay, so then carrying on from this, let us say that you've done a brand valuation, you've used the brand strength score, you've figured out what is the amount which should be allocated to the brand, and you've given a report. And now the investor comes back and questions your report. Okay, so he says that you could have used a different methodology. Like Chinmay also disagrees with you, let us say. Okay, so it's basically all of us agree to disagree, but there is a disagreement. Chinmay disagrees with you, and he says that based upon my research methodology, the value which you've attributed is incorrect. How would you handle such a situation?
Sure. See, the point is that, first the principle we establish when I'm doing my valuation. When I say principle, like how Chinmay said, I will start with that particular point, that whether whether it qualifies to be an intangible. If it qualifies to be an intangible, I have to substantiate clearly that it gives economic benefit to the owner. If it gives economic benefit to the owner, nobody can challenge me. I can stand my ground very sound, saying that yes, it has a identity of its own. When there is a saleability of that particular identity, McDonald's can be sold irrespective of the value chain it has other than that. So which means I will establish that part. Now comes the assessment part. When you say the assessment part, it is again, different people will have different approaches to follow that, which is applicable even to a business valuation, will be applicable to brand valuation also. If the identity is established, now comes the approach. As commercial valuers, as business valuers, we follow what I told you, that easiest way to say is that what is the royalty people pay for similar products to get that. That's an established way of getting a number. Second, as I said, that there are global published studies, but like what I said, brand strength score, for example, is in the marketing world, that is an established study to say that for a retail industry, for this score and with this valuation is applicable. When I do my approaches and I substantiate with 2-3 approaches to say that this is the range I get in, so that is the judgment which I will have with the substantiation. If the other person is challenging, he has to come with another approach of assessment, right? I will have to counter that my economic benefit is suitable to the approach I have followed.
Right. So then let me then ask Ganesh. Ganesh, please carry on. You want to say something?
Yeah. Sorry, I think this is very close to me actually as far as brand is concerned. See, I would do, since you asked me, do I need to allocate a percentages? What I do typically is, let's take restaurant business since you use the word restaurant. I said that, okay, listen, here is a restaurant. What does it give to me? When I go and establish another restaurant in another vicinity, because of my name, people are going to come, and therefore I save in terms of certain time to reach to a certain maturity stage. That's what brand helps me, number one. Number two, brand helps me in terms of getting that excess profit as compared to any other routine restaurant, whatever that excess is. So, but how many restaurants can I really open over a period of 5 years? So what is the size of that market? How much market share I get? Therefore, how much excess profit I actually generate because of this particular benefit of brand. That's what I do it. Because when you use the word, I mean, I understand Vikas said royalty. Royalty, see, globally, the company, there are a lot of patterns and you get a percentages. So in India, for example, you say you start Coca-Cola, there's a local brand Coca-Cola also comes in there. And people just don't differentiate. And I'm very clearly, people are happy to take that. So for a brand to live up to a particular promise, we have to actually start measuring it. Okay, here is one restaurant. Okay, how many restaurants open over the next 5 years or 10 years? Give a perspective. Can that brand be used, for example, beyond restaurants? Say, for example, tomorrow he wants to start a water cooler manufacturing. If the same brand is used, like Tata is used for everything, right? For IT to salt to everything. So you have to feel wherever it can use it, identify the likely profits. Beyond a particular point, you won't get it. That excess profits, you discount it, you get a perspective of the value. And what you're discounting is a function of the risk element that is there. How much it is risky, you discount according to risky factor, you get a particular brand value. This is.
So let me ask you, Ganesh, on a related note, because you have a lot of experience as an advocate also. Now, let's assume that there is a difference of opinion. Potentially, it's an area where there can be a difference. That is, Chinmay disagrees. I mean, he has a different approach, not really disagreeing, but he has a different approach. And Vikas Suresh has a different approach. You have something also which is different. Now, obviously, the investor also feels that he has invested in Zomato on the basis of a valuation report, let us say. And now he feels that if the share price goes down, the valuation report was the one which has caused him to invest, and therefore there should be a liability attached to the valuer. I know that you're disagreeing with me at the moment. So let me put out the question a little bit more. So now the valuer has put in a number of assumptions in his report. He has stated that these are the reasons why I'm valuing the company in this manner. And the investor relies on that and invests. What is our liability as a valuer for whatever assumptions we have stated in the report? So should we state the assumption? Should we not state the assumptions? Is it better or worse? And how do we protect ourselves as valuers from what are the potential actions which can come from third parties to whom we may or may not have issued the report?
See, if you disclose it, you are fine. Remember when you say whether to disclose or not. I mean, I know, let me put a caveat so that, I know you have been very praising here. My being an advocate is relatively new, but as a commercial agreements, I used to do a lot of earlier times. I'm more a business guy. I've been in the business side for a long time in my career. Now, to specifically answer, when I look at law is always about if you have disclosed, no liability. If you have not disclosed, then the question is you are not transparent, what can happen? So if you have disclosed all your assumptions in your report, you're absolutely fine, you're safe and sound. No one can question your any liability on you. Because at the time of disclosure, people have to go through it before they make the investment. That much I can reasonably be confident as a lawyer to tell you that you are fine. And only thing is the draft bill of values is coming up. I'm sure you would have read it. There they are talking about liabilities to be put up and all that stuff. So one has to wait and see what is coming from a regulatory perspective. But otherwise, under the principles of natural justice, you are absolutely fine if you have disclosed.
Okay, so you believe that disclosures are more likely to it's better to disclose our assumptions and what we have done in our valuation rather than not to disclose. So is there any differing viewpoint? Chinmay, you can round up the rest of the discussion on the Zomato also, and then a differing viewpoint, if any.
Yeah, I totally go with Ganesh, as disclosures are very key. In fact, I would take a lot of emphasis on how do we report rather, compare it to time allocation. Okay, valuation is one, but what all we disclose is the other one. And what all we take representation from management. There may be some things which we disclose what management has told, and there may be some things which we need not disclose what management has told, but we should maintain in our documentation, which could help us rely on in future. If there are some things which we cannot second and which we need to go with the management. And sometimes also in some cases, what I've gone through is there is a claim of management which would not be too, too comfortable in taking it. Or there may not be any clear way of getting a justification outside also. More so in regulatory scenario. In case of a pitch valuation or something, this situation would not arise. But more so in case of a regulatory valuation, you may face a situation where there is a representation, you need to go by that, but you may not have, there may not be adequate resources to back it up. In which case, you could also consider disclosing or caveating your report, saying that this is based on, let's say, a term of the SHA. You can't get hold of an SHA yourself for various NDAs and which is signed up amongst the investors. So you could say that particular feature of the instrument is based on the representation from the management. That's an assumption or a caveat in the report, and then go by it. So that is a good disclosure. Likewise, do a proper disclosure so that you can answer.
Right. So let me just ask you then, Chinmay. Suppose the management does not give you a representation letter. Okay, what do you do in that situation?
So see, as I said, if there is something which I cannot corroborate outside what management has told, if there is a projection, and I also believe that that is right, then I don't need to rely on management from the representation letter. I go by just as a facilitation, I may take their numbers and views, but if I vouch for it with my study, if I can reconfirm it, then no need of management representation. But if there are things which I need to rely upon them, like I said, a clause of a SHA which I'm not privy to it, then if they're not giving representation, then there is that's the end of the road. I can't issue the report at all if they don't give the representation for such things.
So you will not issue the report is basically what I'm hearing, in case you don't get a management representation from them and you believe that you have to rely on it, right? Yes. Okay, so that's a good viewpoint. I think that's very important for us as valuers to be clear. When will we issue a report or not issue a report? Get the management representation, I think issue a report is what we do.
Can I just put a caveat here, since MRL has been sold? One sentence. Purely relying on MRL, but if it fundamentally differs from your views in the value, then you cannot give a report, because MRL is a way of taking confirmation from the management, but which you are also reasonably in alignment with that. Suppose, for example, if you would like to assume that a particular growth is not possible in your perspective, MRL says that they are going to give this projection, they're very happy with that, and you just give a report with it, you are not using your independent assessment of what's going to happen. So if someone is going to give a huge projection, you're going to change your discount rate accordingly. Purely relying on MRL to give valuation as per the requirement is also not enough action to avoid liability.
Yeah, so that's a good point. No? This is another point which actually as valuers we face. We have done our due diligence. We find that the growth rate is, let us say, 10%. Management comes back with 50% CAGR. Okay, saying that this is the basis on which the valuation has to be done. And obviously you're different. They've given you a management representation. We will hit 50% and we are backing it up by certain data. Now, as a valuer, what you're saying is that what do you do? You step away from the valuation, or you issue it 10%, or you say that management says 50, I believe it's 10. What is the approach which you would take in this case?
You asked me this, it happened to me, straight answer. So there were a lot of to and fro that has happened. So for example, someone says 50% growth rate. So for 50% growth rate, where is the infrastructure? Where is the capacity that you're going to invest? Show me the capacity. What kind of order book you have it? You go into the detailing to the next level to narrow it down, and how industry is growing, why you are different. You start writing it out. So one of you must be convinced. Either management is convinced or you are convinced. You cannot do an engagement where both of you are not at all convinced at loggerheads and still give a report together. That's not possible. So then you walk out if you're not able to come together.
Fine. I think that that conveys what most of us would do. Okay, so Shilpa, I think you should take some of the questions, because I think Sheetal has a lot of questions in the chat box. If you can just moderate.
Just one point here. When we talk about disclosures and assumptions and all of that, Will it come down to basics like risk-free return? How did I take? What was my assumption? Where did I take? Market rate, how did I take? Beta, how did I take? Do you think that, liability of the valuer will be to some extent, safe because you have assumed something and you're corroborating as to what is the source of it? Because I have seen some valuation reports wherein none of this is explained. They just have a table and that's it. Why beta, what beta, where they have taken, nothing is disclosed.
Well, I think that, Shilpi, let me just say that when we do valuations, now we do take all the parameters which you're using. So market return, how we have derived the market return, we put that into the report. And let me also state the counter viewpoint to this. So we do that, we take out market return based upon Nifty as a certain number. We know what is the dividend yield which is there. We know what is the beta which is there. It is computed. All of this we state in our report. Now, when we look at what, let us say, an alternative valuer was doing, like for instance, one of our reports was being vetted by a KPMG, and then last week asked to chip in here. Okay, so what they said is that there is a certain market risk premium which is there. Okay, and based upon studies, there is a market risk premium. Therefore, use that market risk premium on top of the risk-free rate rather than use what your, see, my method is to go with what is a Nifty return. Whereas the KPMG thing is saying that use a market risk premium. Okay, so there's a different approach which you take to getting to what is the market return. So here, let me ask Vikas, what is more reliable?
Yeah, Abraham, I have seen both methods being followed, and using the risk premium on a standalone basis. In my view, it is a very narrow perspective. The reason being that I myself have done studies when, especially during pandemic time, if you notice, the risk premium and risk-free return were getting interchangeably being used. Now, at this point of time, if you fix the risk premium without adjusting the risk-free rate of return, you will get a very skewed answer. So it's just as to say, if you are using risk premium as an approach, you will have to update your risk premium more frequently. Whereas now you understand, right? You take risk premium or you take total return minus the risk-free rate of return should normally give you same answer. It is only how frequently you are updating it. So market return, if you are taking a long-term return of market. So unless there are significant volatilities in the market which require correction, then you change your market return. Otherwise, you normally can be in the narrow band. But if you do risk premium, then you have to actually more frequently update your risk premium studies, which is my view. And
okay, got it.
And limited till I was there in KPMG, we used to follow the market return approach.
Okay.
Even I have seen, few of the values don't take dividend yield into consideration. They just consider pure market return, ignoring the dividend yield. I have seen such reports also.
Okay, of late we have started using dividend yield. Let me say that before we were not considering, which I think was wrong theoretically, but we have started using dividend yield also. So let me ask Chinmay then, what is your approach to this? You'll consider dividend yield on top of the market return? Sensex return?
Yeah, okay, this question is for market return, right? Market return computation.
Yeah.
So market return computation, we just go by the Sensex or whichever index. I think we use Sensex, which is the longest index which is there, and we do a two-level computation, which is take the 30-year or whatever period which we get the return, and then do last 5-year average. Let's say in simple terms, 30 years to let's say 1990 to 2015, 1990 to 2016, 1990 to 2017, like that kind of a computation and average of that. So it is to ensure that there is the cyclical movement of downwards. Let's say if the market is in the, let's say 2020 June, it was in the bottom if you compare to the last 2 years, our return should not get influenced by the cyclical bottom of the market. To ensure that we take the
So, but will you add a dividend yield on top of it? So, because the market return is basically capital appreciation, which is what we're seeing in the Nifty. So, a dividend yield is also giving you a return. So, will you add that on top?
Yeah. Dividend yield is generally not added. In my view, the proportion in which it get affected is too insignificant.
In fact, just to add to that, Abraham, the same study, because we are talking about dividend yield, we have studied the market, dividend yield and the overall market is actually hardly significant in capital market.
But about 1%, it will change.
1%.
Let us
If
say.
1% is quite big, it is not even 1%. It might be, I would be surprised if it is anywhere crossing 0.5 or
No,
even
no, it's
0.3 or
1%. It's given in the index itself.
no, you are saying 1%. You will have to look at it as an overall market and
The
not
dividend yield for BSE index is 1.57%.
of the Sensex you're saying, right?
No, that's a data available in the internet. I think someone has published that. This is the authentic data. So it is 1.57%. Somewhere at the Nifty, I believe it is around 3%. But the first one I can recollect clearly from my memory. Second is probably from a late memory.
Sure.
So let me put it differently, because
yeah,
let us say in the US, let us say we have a 5% return, let's say on equities. Let's assume that's the number. On top of that, you have a dividend yield of, let us say, 1%. So very significant. So 5% becomes 6%. In India, let us say a return is, let us say, 11% in the market. On top of this, we have, let us say, 1% as dividend yield. So is it significant, not significant? Should we ignore it? Should we mention in our report? What's your thought about it?
So simple point is the return when you are computing from the stock prices, the stock price, if you want to consider it as a dividend yield, so adjust your stock prices for all your cum and ex dividend, because stock prices also have that extent of volatility. Remove that, adjust it for ex income dividend, find the return, add the dividend yield on top of it. That is the right.
Okay.
Abraham, can I chip in something on this if it's okay?
Yes,
I want to ask these questions, even the fellow panelists, including you as well here. If you are going to take market return, how would you take the risk, the premium part with respect to the re-rating of the stock market? Because now when you say you're going to take the historical market return for 3 decades or 2 decades, or markets get re-rated. One simple analogy is when the market moves from currently the Indian $3 trillion, $2.5 trillion to $5 trillion, the market gets re-rated nearly 8 times. That's how historically global markets have performed. So if you were to look at historical returns, you are actually undervaluing your potential upside. That's my question.
Okay. So let me just pose this back to Chinmay, because Chinmay used 2 approaches. First, he said that let me take the 25-year or 30-year return, and then let me also take a 5-year return. So Chinmay, was this to get the direction of the census? How do you use the 5-year return as compared to 30?
Yeah. One is the direction, and to more so, it is not exactly 5-year return. As I said, 1990 to 2025, 1990 to 26. It's not exactly a 5-year return. It's a 5-year return of CAGR in generalized. So
moving average, you mean? Moving average.
Yeah, it's a moving average. So to answer Ganesh's question, see, I think my view is futuristic is the best way. I mean, there is no doubt about it. That's the best way. If one has right numbers and right information about the futuristic, that's the best way. And historical computation is always secondary in my view. But at least what I follow is the historical, because for me, the data, what I get and what I have in my hands is not too great for the futuristic. So I still follow the historical. But if one has the access to the data, if you have the study reports and well, I think we should go by futuristic return.
Okay. Okay. So over to you, back to you, Shilpa, for some questions. I think that Sheetal also, those questions, you find it at the right place, you just bring them in, please.
Yeah. How to value compulsorily redeemable preference shares or compulsorily redeemable debentures? Do we have to value fair value of equity or fair value of debt for this kind of assignment? When as a valuer, we know that company is seeking valuation report for issue of such securities.
So let me just state first and foremost, and I would like the participants to mention, if required, how they value. See, the basis of valuation for us is the Companies Act. So we have a section 62, which we have to refer to. We also have to refer to the rules, which is the prospectus and allotment rules, and the share capital and debenture rules. Now, when we do this, we procedurally get when we need to issue a valuation report. So, for instance, if the price at which a convertible preference share is going to convert at the market price in future, then you can't do a valuation now, because the price will be determined at that point of time in future. And as per the share capital and debenture rules, it also says this: you do the valuation at the point of time later when you're going to convert. Okay. So does is there a need to value now? Yes, there is a need to value today at this
Her
point
point
of time
wasn't
when you're issuing shares.
compulsorily redeemable, not compulsory convertible.
So let's come to that in a moment, Shilpa. So this is the first viewpoint which you need to have when you're doing valuations, because this is a constant question which keeps on coming up. Should I do a valuation at the point of time of conversion? It is based upon the terms of the instrument. If the instrument says that it will convert in future at a certain rate, which is already predetermined, then you do the valuation at the point of time when you have issued the instrument, and then convert as per that valuation. Okay. In case, however, it says that it will be converted at a price which is at a 20% discount or a 10% discount or at the market price at that point of time, you have to necessarily do a valuation at that point of time. Okay, so this I think is a constant question which is there, which has to be addressed. Now, coming back to your redeemable shares, this I will just pose it back to Chinmay. The difficult part I will pose back to Chinmay. Should we do a valuation at the point of time of redemption?
At the time of issue itself, she has a doubt.
Okay, at the time of issue, it will be valued. I mean, taking the whatever return which is possible, similar to DCF method, but the discount rate would be the equivalent market discount rate for an equivalent debt instrument is what we take. And if at all you need to add any premium or anything for company specific, if the company is too small, but the market debt instrument, what you get the comparable coupon rates are really large companies, or for any reason they enjoy the lower rates, we need to add that premium. And using that, it's similar to NPV kind of a computation we use to determine the redeemable instrument valuation.
DCF is
Shall I add here? Shall I add here?
Please, yes. Mr. Vaidyanathan.
See, I think the question was the compulsory redeemable should be treated as a debt. I think the answer is absolutely yes, because there is no way it is going to be converted into a capital instrument. It has to be repaid. How do you do it? Of course, you will have to take the market participant coupon rate, not necessarily the coupon rate on which it is issued. Sometimes you may issue it at 0.01%. I go for a market participant coupon rate and discount it for the outflow of cash of the coupon amount and on the redeemable year, and discount it and say this is a fair value of your redeemable preference shares. That's how I do it.
Yeah, this is what I would also do. Let me find out if there is a differing approach from Chinmay or from Vikas.
Yeah, it's the same thing what I also explained. Yeah. So I don't have anything.
Yeah, even I agree on that, because it's a debt instrument. Compulsory redeemable preference shares is a debt instrument. I would value it like any other debt. Take the cash flows which are impacting out of that whenever is the repayment due, and discount it like how Vaidhi also said rightly, it would be at the market cost of debt, because that is a payment and you follow that market cost of debt to present value the debt.
And how would you get the market cost of debt?
You will use... What if it is non-cumulative and the projection is not supporting a profit for the projected year? How do you guys take that forward?
So if it is non-cumulative, you are clearly taking the outflows are restricted to the capital outflows, right? Clear. We are taking that as a debt. We are saying because it's non-cumulative, there is no coupon payable on that. Because year on year, you are not expecting any dividend payable. It is not carry forward because it is not cumulative. So it's only the principal payment which will have to be paid. And for that principal outflow, you will discount it to the present rate.
Okay. So you go by the validity of the projections given to us.
Absolutely. This is how, I think you should take it as a proxy to if the debt was listed in the market, what would happen? Even the market would consider the same thing. Market participants will take a view whether they will get any dividends or not. They will keep valuing the debt instrument accordingly.
I have one doubt. If the company is issuing redeemable preference shares for 5 years, whether does it require valuation?
Very strict interpretation of 62(1)(c), actually very strict. Okay. It doesn't give any option like whether you are redeeming, converting, simple. There is no option given under 62(1)(c) if you strictly interpret it. But what market does is different.
But I'm asking the panel, it's a practical point of view. If I'm going to issue convertible instrument, yes, we need to value. If I'm going to issue a redeemable preference share, then commercially there is no valuation is required. So, but the 62 there is a it says if it is a preferential allotment, valuation is required. So whether is it required, and if so, what the methodology we need to follow?
Right. I think that we have to go by what section 62 says as valuers. See, what is our perspective? Our perspective is that we have to issue a valuation report when it is required under Companies Act. So if a valuation report is required under Companies Act, you refer to the section under which you're issuing it and you issue it. So in this case, you're going by section 62. If it asks for a valuation report, so typically 62(1)(c) asks for a valuation report. So if you're going to issue a valuation report under that, you should do it. And that's my perspective.
How do you take the market participant return here? Is it typically the rated instrument, you take the spread over that and that's the basis you do it? And how do you determine whether the default can happen?
So I'll just pose this to Vikas, because typically this is something which we use, let us say, the credit ratings of similar companies. And the credit rating automatically builds in the default risk. Is this the right approach to use, Vikas?
See, it's a case that, you know, you are in your computing market return, you are just finding out what is the proxy return which the banks will give or any other lender will give. So the lender will give based on a credit rating. If the credit rating is not readily available, then we do the same approach with what Abraham said, we call it the synthetic rating. So we use the same parameters with any other credit rating agency would have used, find out what is the rating of that company. And then say for this rating, what is the spread they will give over MCLR or, you know, whatever is the bank rates. And then we find out the cost of borrowing.
See, why I ask this question, Vikas, is essentially most of these unlisted small private companies use this as a method for 20-year, 10-year instrument. You know, it's like a quasi stuff. Okay. One is definitely not certain because some of these are also used for fraudulent entries, so which will never come back as a value. And I know this has come even for this Anil Ambani's company, it has come for valuation for me, and I have found such instruments. So I said, unless I have more details, I cannot value, but otherwise I would value it as zero. Because if the entity which has taken the money has actually inadvertently forwarded further money somewhere else, and the money is not going to come. Just because it is a debt instrument, just because it has a interest rating, just because it has some junk rating and you just use that to determine, would you do that or would you use your prudence as a valuer to not value that of any value, such instruments?
See, not valuing is always an option to any valuer, given if it is not fitting your risk appetite. Now, if you tell me you have to value it, if you say me you have to value it, what will you follow the approach? I will go with that idea. If I have to value it, see, as any other investor in that instrument, what I would look at it is first you're saying realizability of that cash flows, which is the standard check. I will value it and say realizability is zero. If you're asking me to value it, I'll value it and put it zero there.
I mentioned that. Okay, correct.
Yeah.
Correct.
So for me to take that view, I will do what, like how you rightly said, what is the realizability of the value? It could be that there is a preference in the time of liquidation. I would take my bets on saying what is the liquidation value I can get from selling the assets and all that. What point of time you may get, and then you realize it.
But are we doing a liquidation value? Why the idea of realizable is being discussed? We are looking at fair value, right?
So when you say the fair value also, when you fair value of an asset, when you say it is nothing but a fair market value, right? If you are saying the value of a particular asset is 100 crores, but all you can realize is 30 crores, would you value that asset more than 30 crores?
No, I understand that aspect, but that company has given to a group company. But where are you? Which part of the standard you go and say that such deep dive has to be done? I understand if it is a CARP case. I understand if it is a solvency challenge, but in the normal course, I'm trying to just get this knowledge upon me.
Sure, please. This is the very first input in your existing DCF methodology. In the first input in your DCF methodology, you are going to give the forecast of cash flows. For forecast of cash flows, you need to know how much cash flow you will get. And this is how I will get the number. So this is the total number, 100 crores. but 100 crores is the total principal value. For me, what I will get cash flow is 30 crores. That is what I will discount. So for me, it's following the same standard. It is estimation of future cash flows.
No, that is fine. That is fine. But I think someone told that they will ask the client, where have you invested this money and how that money is going to be repaid to this. I think someone was talking about that aspect. So the question was on that only.
I think all we are going back to the same points. It's just that these are ways on which you corroborate to know your judgment of future cash flows. Saying how they have used the money, what they have done. It's only we are trying to assess what is our comfort factor on the future cash flows, and we discount the future cash flows accordingly.
Now that we've come to professional judgment, no?
Yeah.
Let me just pose a few questions. So Ganesh, let me just ask you, and this is something which is professional judgment. Okay. Now, how much reliance would you place on previous valuation reports which have been done when you're doing your valuation work, your report? Because the previous valuation reports may differ completely. Okay, they may have gone from, let us say, 100 crores to 600 crores. And now we are valuing it at a point of time where potentially it could be maybe 200 crores, something it could be, maybe higher, maybe lower. How much reliance do you place on the previous reports? And what do you do in your report? Do you draw attention to the previous reports? How we are differing? What do you do?
As far as I'm concerned, previous valuation reports are not for me to look at the value that they got it, are more for what are the assumptions the management has given and what the assumptions are standing today. That tells how reliable the management's their own estimates or their own growth patterns. For example, the previous valuation was 200 crores and they have made certain growth assumptions. And today I see that growth assumptions they have either in excess or less, it differs. That gives me a direction how to look at for future from a growth perspective. So when I look at previous reports, yes, absolutely. Not for the value, what they got it, but more for the assumptions inherent they have taken there for my stuff. Whether I'll report the previous valuation reports in my report, it depends, probably not. It depends on the case-to-case basis. But as long as if I'm in alignment with the management today about the futuristic assumptions for my valuation report, I don't need to consider the past valuation.
Mm-hmm. Okay, let me add on to this question. See, now suppose you find when you're doing valuations, some degree of forensic checking, you find that previous valuation reports have not been paid for. Okay. What would you do in this situation professionally?
Professionally, it has nothing to do with see, any engagement is a contract between two parties. So as why that contract was not adhered to is up to those two parties. And unless I'm sitting as a judge to understand here both sides and then take a call, I cannot take a judgment. So I'll be biased. So whether Ajmal Kasab has been represented by a lawyer, yes, despite everyone knows that he was shooting all over. So I would not deny for that reason. So from that perspective. Now coming to the second aspect of it, you asked me what would I do? I'll be more cautious in my taking over this assignment because it can happen the same thing to me. So I might say 100% advance before I start the engagement.
Mm-hmm. Right.
But would I deny because someone else has not been paid? Probably not, because I am judging already the management on that issue without knowing the facts.
Right. So any other perspectives? I mean, Chinmay, what do you think? Professionally, how should we handle such assignments?
On the last bit of the question, the fees not being paid.
Yeah.
Yes. So even I've faced this scenario multiple times when I very well second what Ganesh has told. In many cases, it may not be the issue of the management also. It may be the issue of the earlier valuer also. So as long as you know the management team, if you know them, they've come with some reference, then you are clear what to do. And sometimes you may want to take risk even though going ahead and do the work. But if you are clear that there is intention issues of the management and rather invest time and take the risk and go ahead, you may ignore and move on to somebody else who is much more fairer. But if you are clear that I mean, there could be some other issues involved in the previous engagement, as Ganesh said, if there is a possibility to take the full advance and do the work, that would be the best way.
Mm-hmm. Right. Right. So suppose, let's say you've issued the valuation report and then they don't pay you. Now, do you pull back the report? What do you do with that?
That was for me.
Yeah, you can answer, Chinmay.
Yeah, generally I've not done that. In a few instances, there have been the cases that they have not paid. Generally, I've not done that. But in no case, there has been a kind of completely negative conversation. They may have explained as, okay, pending did not happen or something went wrong. I'll pay. They'll not say will not pay. They'll say I'll pay. Give us some time. Give us some time. That means after some 1 or 2 months, we need to understand they won't pay. But I've never pulled back the report once the effort is done and it is there. If that is being useful in the right way, I mean, it'll just see the use. And we have also learned in the process of doing the work. I've never pulled back the report. But it's a caution. Generally, we do 50% advance fees wherever there is, especially where there is no reference. It has not come from a reference, or somebody else doesn't know them well. We may not do without advance. But if at all, if it is issued, we don't please try and see pullback in general.
So is it usually advance before starting work?
Yeah, if there is no reference, if it has not come from anybody, either if it is our own client, then subsequent engagement, then there is no advance. If it has come from, let's say, if Shilpa has referred or Vikas has referred, then also there may not be any advance if you have known the client from a long. Otherwise, it would be definitely 50% advance.
And 100% before issuing signed report.
That we don't insist. 50% advance is what we generally follow.
So let me say that you've issued the report, client has paid. See, these are all professional judgment issues. Okay. So now you find the client or somebody has found an error in your report. This is a practical situation. The client has found an error in your report. How do you tackle the situation? Will you go back and change the report, or you reissue? I mean, meaning that will you reissue the fresh report for that, or how do you tackle it? What do you think, Ganesh? What's the viewpoint which you will have on this?
Is it material error or not material error? Let's start with that. So, because any report which I have done recently also, I discuss my report before finally issuing the report. So it's not that, I just submit a report and something surprises come later. So to that extent, there should not be any material error report at any cost. Okay. But so non-material doesn't matter. I think no one really bothers about it. But since you asked I will give you an interesting anecdote here. Rothschild was the investment banker. It's a fantastic valuation done. And, I was doing internal investment valuations so that we can come to a conclusion that we are doing the same thing. So I was doing parallelly my stuff and their side. So we all sat. I mean, it's not about Rothschild. It's just an example. Okay. So don't mistake me there. So we all projected this and we were changing the assumptions, and their valuations were significantly higher than my valuation. And I was wondering, I said, okay, let me take more conservative their estimates. Maybe, they could come to my number. So no matter what number I'm changing it, the valuation was not coming down. In the proportion it was supposed to come down. And after some time, then we realized, especially in a finance company, cash is a raw material. So they have to accommodate the cash adjustment, which they have not done in their entire valuation. Now imagine a good investment banker when projecting and giving a client, which involves thousands of, hundreds of crores, that is a material error. And it's just that I have done parallelly another report, and that is when we narrowed down. The moment we adjusted in the report that numbers, with the tough assumption, the value has come down significantly. So that is a major error. So if such errors happen, how do you handle such cases? I have not done such errors. I don't know how to do it. But as a valuer, you better be careful that you don't make fundamental material errors.
No, so it's been done, let us say. The error is there. How do you tackle it? I mean, we have to give this because I'm sure that our participants at some point of time will have errors in their reports. We need to give some advice somewhere, no? An approach. What do we do? Do we reissue the report with the same date or current date, or what do we do? What do you think, Vikas? What do you think?
I think clearly as a professional, having coming to know of that that's an error and somebody is working on that, I won't not say that change the report. Maybe you might if it's like how he's saying that if the error is material, you may need to issue a corrigendum for that. Clearly, I think we have to own that mistake, or we have to own that and take it up. how it matters, and based on your, what was the intent and purpose. If the intent and purpose was discussion between two parties, then clearly it ends with the, a discussion with the two parties and a corrigendum which gets on record. If it is a compliance, you actually make a formal letter and, you place that correction on record. And sorry, I'll just use this point to touch upon the earlier two questions which were only dealt with from a commercial standpoint. There is another angle to it, is also a risk standpoint which we have not commented on. Say if the first case which you had touched upon, to say that if somebody was not paid the earlier fees, or if somebody was not paid the earlier fees, one way of looking at it is that, okay, he is not paid, whether I take up the engagement or not, whether it's a payment risk. But I would view it a little differently, to say no value would have backed out that way. Was there any issue for me? I want to see that, I want to get the smell. Was there any integrity issue which he backed out? If that is the case, I want to be more alert on that. I don't want to miss that out. That if he was not paid because he did not give, or if was there any integrity issue, if it is a commercial decision, then we will go the way everybody has a view, the similar view of all, that I'll protect my interest. But if it was an integrity issue, then my decision making is clear.
Okay. But let me then add one more question to this professional judgment. See, the thing is that we rely upon client data for issuing the reports. Client just does not give us the data for issuing the report. What do we do? How do we bring the engagement to a close? Do we issue a report? Just let it be? How do we tackle the situation?
This is more in case of IBC valuations also.
I guess this is more in case where your engagement is not with the user of the report. You are appointed by one side and you are collecting data from the other side. This is typically buy side, sell side conflict, which we always see. Though, so if that be the case, if there is still a requirement to issue the report with whatever it is, I would say that you are aware of this situation upfront. It is not a new situation that you are going to foresee. You know that you have to make a buy side report. Seller will not give you information. You make your assumptions. You have agreed some approach with the buyer. So I think you will put down your rationale in the report, and you caveat it accordingly and close it. It typically happens even in a diligence situation when you are doing a buy side diligence and the seller doesn't give you information. So what you do, you just caveat, you make viewpoints, you make your corroborative checks, and give how you have put down your assumptions there, and give a support to the buyer.
I think since Shilpa was saying this happens in IBC, actually in IBC it's relatively easier. If the data is not given, you say data is not given, therefore the value is 0. No one is going to question. RP is happy, everyone is happy, COC is happy. Here. So the question that Vikas said, the other case is really difficult, where actually you're doing non-IBC transaction, where there's a buyer and the seller. But in this case also, I would say valuer makes assumption, but it's not, I would not call valuer making assumption. I would take the buyer. In this case, if seller is not giving, I'll sit with the buyer and enable buyer to make those decisions. What are his going to assumptions that he will have in future about the particular opportunity, and based on that, I'll sensitize the outcome. So I would, while valuer is enabling it, it's not valuer making it, is only an enabler. To that extent.
I have a question here.
One point to add here. Maybe sometimes I have seen such situations in disputes and in terms of differences. See, the point is that at end of the day, by saying no data, no valuation, we are not giving a solution to the IPC guy, because he will get stuck. Zero valuation means if you give a report, zero valuation, he's happy. Then he can sell it at any value.
But you have no choice. What happens is, in IBC, if they don't give it, valuer cannot take assumptions, because valuer is questionable. Anyone can actually pull up. In one of the IBC cases, a 0.2% COC member or less than that, everyone 80% COC guy, everyone accepted my report. The 0.2% guy writes in writing to the RP that ask the valuer to change the numbers, otherwise I'll complain to IBPM. So I actually went, I said, okay, call me to COC, your COC, I'll come and sit there. And then I actually narrated to them the entire thing, why I have taken all the numbers. So the moment you go and confront with facts and figures, then no one is going to question. See, the point is the why we fear when we have some challenges with others. If we don't have anything to fear, nothing can stop us. We just go and face everything. So in IBC, if RP is saying I'll not have data, so how can I evaluate? I cannot take assumptions as a value.
No, I agree.
Sir, Ganesh sir.
Vikas, Sanjay,
I
yeah.
think Sanjay has a point. Sanjay, carry on.
Yeah, because I had a question that we sign the engagement letter, correct? And after the engagement letter is done, we get all the data. But there's one piece of data which is not come in. Let's say that we are valuing on an August date, correct? We have the March data, August has not come in for the cash flow purposes or the cash balances purposes. So in that situation, if it is getting delayed or whatever it is, between the engagement and issue of, should I hold back the report or I should just issue with caveats, as Ganesh said, and just go ahead? Or is there a reasonable time frame? What is the time frame that I should wait for that information still to come and then issue a report? Or I should just hold back? What do people do?
The question is to me, right?
Yes, Vikas, carry on.
Sure. See, I normally go with the purpose of my engagement, the end objective of my engagement. If it is a transaction and the buyer seller are okay to live with that kind of a margin of error, I will go ahead and issue my report. And when I issue my report, only place which I will do it, I'll ensure that I will put in that these are the data gaps I have. And just put a caveat so that the reader is aware of your shortcomings there in the data. Second, I will put the date up to which the data was provided to me. I will ensure that I put it. So even if I'm issuing a report today and the last information I got saying 31st August, so I will clearly put in a note saying that this is based on information received up to 31st August. Any subsequent events or transactions or information could materially vary my valuation. If so.
Okay. And should I wait or should I just go ahead and issue the report? So I mean, there's a due diligence which is going on in the entity. So the data is getting delayed and we are not getting it. So is there a reasonable time we should wait or we should just go ahead and issue the report?
So you have been asked for the report, right? Your engaging party is asking for the report. He's still pressing you, right?
No, he's just silent. I mean, he's just engaged and then paid the money and is silent on this. So,
then the question is whether anybody requires the report. Point is that you issue the report also, nobody's going to see it. So you are just finishing your duty by giving a report. So in which case, if you see that the data is not going to come, what I would do, because as an engagement, I have received money and I have to give a deliverable, right? I have to close my engagement. I will give an interim report. I will give an interim report with this update saying this is what it is. Unless until I get any further data, this should be treated as a final delivery.
Okay, so that's a good,
I think that's a good solution, Sanjay.
Good solution, yeah. The interim report you can give and then just say that this engagement is over. If there's any update, then we can be updating the report should it be required.
I think that special stand I would take, because in case they give me data later, that is an extra effort from my side that I will invest in getting it redrafted. But otherwise, I am bound to give a deliverable to my engaging party because he's already paid the money to me. I will give him an interim update, at least document-wise it is closed.
So any restriction from the RBO sides? I mean, have they come back, IBC or RBO, that you've taken an engagement, you've taken 6 months, 9 months to deliver a report. So is there any such restriction or no?
I would request Abraham or anybody else.
Yeah. So the issue is that, Sanjay, the issue is that we are supposed to report to IBPI the date on which we have got the engagement and then the date on which we have completed it. So the moment we put that in, if we've taken 9 months to complete a valuation, our issue is only that. If somebody from IBPI decides that it's something which needs to be taken up for further investigation. But that's actually stating the facts. Now, because, for instance, I've had a situation where the appointment happened in January, data just didn't come. And this is a regular client of mine. And they wanted the valuation for the purpose of knowing what the company is worth because they were going to continue doing issues in future. Okay, so they just keep on having a report from time to time. So it took me almost about 9 months to close this. I couldn't close the engagement because the regular client and they need it, but the data was just not coming. It took about 9 months. So I had to report it in my IBPI valuation thing that it took about 9 months to close. Okay.
I would support this. Sorry, go ahead, Chinmay.
Yeah, just one input or as a suggestion. Many times it is so both in signing the engagement letter and getting the data, fees, and all of that. A little bit advance invoicing would always help, because once you have invoiced and the client is paid, they will also be in a pressure to give us the information because they have paid the money and they want the service. So that is one thing which has helped me a lot. Whenever there is, you feel that there is, because we need to identify where is the pinch. If the person is not giving the data, then possibly you're approaching a wrong person and you approach the buyer, and it's a deal, right? So if the person wants to sell and the buyer doesn't have the report, then buyer needs to push them to give. So you identify where the pinch is and then approach the right place. And Advance invoicing also is a very good incentivization to get the data.
Right.
Thanks.
Okay. So Shilpa, I need you to take on some of the other questions which you're not handled. Or okay, pending. Okay, Shilpa, you have some questions.
Yeah, actually, I'm thinking whether to take it from chat or how should we take it?
Yeah, because some of the chat questions we need to take on and answer them because I'm not really seen.
Yeah, one of these important points, what I have already received is, say, for example, it's a case of a merger, company X and company Y. Normally, it is like whatever is the swap ratio we are supposed to determine. In case of a complex capital structure, say there are, optionally convertible, compulsory convertible, preference shares or debentures, how exactly the swap ratio has to be given? Like for each capital structure, should it be given, or should we just give, fair value of equity share, whatever swap we get? What is the, what
Chinmay, I'll
NCLT?
address it to you.
Okay, yeah. So this is simple. We just need to go by the scheme of arrangement. Whatever is the scheme of arrangement is, let's say, for example, there is a preference share. For a preference share, if they're giving preference share, or for a preference share, if they're giving equity share, based on what scheme of arrangement is, we need to first go by that, and then determine the valuation for all the instruments. First, okay, there are two things. We determine the valuation for all the instruments, and then see what is the scheme of arrangement, and then match it. Whatever value you have done for every instrument, respective instrument of the transferee company, what is being issued, you match it and arrive at the swap ratio.
Okay. So I think that addresses that, Shilpa. That's okay.
Actually,
Okay,
may not be clearly.
I'll help you. I'll try to help. I'm not sure whether I can be good at this. Okay. So 3 entities are there.
So, sir, just to add here, since in the scheme of merger, one entity will cease to exist, all the shareholder, be it equity or otherwise, has to be compensated by the unmerged entity. So your valuation report should specify share swap ratio for each of the holders of the merged the entity which is going to be ceased.
Correct. And suppose the scheme of arrangement is not finalized and they bank on the valuation
Scheme
reports.
of arrangement and what your swap ratio are two different things. Scheme of arrangement, the input from your valuation report may go into the scheme of arrangement.
Yes.
So we are talking two different things altogether here.
No. Okay, I'll clarify. See, swap ratio should be an input taken from valuation. However, the scheme of arrangement should be clear from the perspective of who is getting what stakeholders are getting what in the merger process. If let's say equity, preference, and debenture 3 holders are there, all of the 3 holders, whether they'll get equity in the transferee company or the respective classes they'll get in the transferee company, should be clear in the scheme of arrangement. Because unless that is not clear, there is no way we can arrive at swap ratio. So that clarity we should obtain, and concurrence from both the management should be there on that. And then we do the valuation and then give the swap ratio.
Just to add to what
fairly articulated.
Yeah, sorry, I think it's done. Then I think what.
Okay. So Shilpa, the next question then.
Yeah. How to value unquoted shares? Especially when projections are not available, when company X we are valuing company X and already, we have an investment in some other company and we don't have any relation with the management. So projections option is ruled out. How do you value the unquoted shares?
Okay, so this is something where, let me give you an example of what I've done, then I will just ask the others. See, we had a company where we had to do the valuation. It had investments in 2 companies. One was a real estate company and the other was a IT company. Okay, so the real estate company, logically the subsidiary, you should be finding out what is the guidance value and attaching that in the valuation of the subsidiary company and then taking it back into the holding company. It's a holding company, meaning the company is just holding a certain percentage of the shares of the of that particular company. So guidance value not available. So therefore, what do? You have to take whatever was the last guidance value which was available and use that. So that's what we actually did in that case. Because as far as the management is concerned, we were issuing it for a purpose where they said they just wanted to compute the internal value for certain transfers between themselves. Okay, so there is no statutory liability for us. So therefore, we used whatever was the best judgment in calculating what's the value of that share. Now, in the case of the other company, which was a IT company, there was a last issue in which they had obtained capital. So there was a valuation which was available. We also looked at the tax returns and found out when they had sold shares, what was the price at which they had sold some shares. So there are multiple transactions in that company. Based on that, we derived a value because we were not getting data directly from that company. We had to derive the value based upon whatever was available in the public domain. So we did that using these alternative methodologies and came to a value and put it into our holding company's valuation. So this is the approach which we followed, and I hope that answers that question. Let me, however, ask Chinmay, what would you have done in this situation?
Yeah, market approach is relatively more easier in such cases where you do not have the data. Even then, some bit of data would be required. You would need to know how do you differentiate the target company of the market transaction which you have taken and this company. So depending upon the size of company, if some data availability is there in other sources, like it could be their own website, it could be their financial statements, or anything which is in it. If it is in a transaction, any documentation given in a transaction. To that extent, we can see in some instances we have done the valuation like this, where market approach we have taken and other sources we have used to get other information what is possible. And in one specific example which I'm referring, there was really no issue in obtaining any information. There was any lack of anything at all. We could get everything without depending on the management. But if there is any slight dependencies, especially in acquisition situations, you may face this scenario where the seller is not giving the information and the acquirer would need the report in some urgency. You would need to see at least what basic information you would need to adopt the market approach also.
Okay. Right.
But definitely income approach would be very challenging in my view, even though you have your ways of identifying and corroborating the projections, but various other things in the projections should come from management.
Right.
Yeah. Actually, I have received many questions on conflict of interest. Basically, if any valuer has already issued a valuer report, there is a very, discussion among professional groups that, he should not take up second time valuation. Another thing is, if there is if he is a statutory auditor, can he take up? If his firm is a statutory auditor, can a separate partner who is nowhere related to that particular audit assignment, can he do? If he's a company secretary retainer, can he do? If he's a secretarial auditor, not a retainer, company secretary services, he's the retainer. One is retainer, another thing is secretarial auditor. So,
let me just address one part of that question, which is if I've done a valuation of a company before, can I do it again? Yes, I should. In fact, I'm better qualified than anybody else to do that valuation again, because I've done so much of due diligence on that company, and the amount of time which I will spend in assessing and corroborating valuations will be far less. However, let's refer to, let us say, GaneshRemani on what happens in case there is alternative work. Like, for instance, company secretary is doing valuation reports. They're also doing, let us say, non-compliance related work. Let me assume that they don't have to certify. They don't have to certify. They don't have to put out a statutory report, but they're doing regular work. How does this affect the valuation, or what is your viewpoint?
See, I would answer in this way. I don't remember the valuer's code of conduct, but IP's code of conduct, insolvency professional. The code of conduct clearly says that it should be impartial, unbiased, no conflict, no pecuniary interest beyond a point of time. As long as you satisfy this, and as long as you disclose it with complete transparency, and if it is not clearly debarred as per the law. For example, if you have done audit for 3 years with so much, then you are not allowed to do in IBC certain assessment. So as long as that you're not debarred from that, with complete disclosure, you can absolutely do all these assignments. So because if they wanted to do clearly restrict you in law, it's always written clearly. If it is not written clearly, then as long as you disclose and act without any bias or this thing, you are fine. You will not be questioned. So to answer Shilpa, all these things, you just have to see whether you are absolutely not allowed. And if you're not absolutely not alert, be rest assured you can do it, but with complete disclosures, you are fine.
Yeah, I think the key is disclosure then. Disclose and then do your report. Okay, let the user of the report make the judgment call as to whether you are conflicted or not based upon disclosures. Okay, what's the next question, Shilpa?
Statutory auditor and some other partner taking up, like very big firms are there. One vertical would have taken up audit, another vertical, like maybe Chinmay
Okay, so this is, let us say, Chinmay. So
Yeah,
Chinmay,
yeah.
let's say,
Understood the question. Very simple, no at all. Definite no. Not from the valuation perspective, but audit perspective, it's a very big risk. It's not only different partner, even if it's a network firm. Within the same network of firms also, it is not required. So we should be very clear in the communication between the network firms also as to what are the statutory audits we are doing, and so that they should not do valuation engagements. Because it's a risk of audit and not of valuation. So that's very clear. You should not be
taking up that Companies Act provision.
Yeah. So you're not completely independent of doing the audit if you're doing the valuation.
you can't comment upon your own judgment.
As a management input, it is somehow perceived as valuation means you have a lot of engagement with the management, and valuation is an input to the management. So there is one relationship. So you're not really independent when you do the audit. That's how it is viewed at.
Actually, this is a very regular issue. We have three types of arrangements. One is secretarial auditor, statutory. Second one is retainership. Third one is providing services without having any contract. Under these scenarios, if a person is secretarial auditor, can you do the valuation? Second thing, if he's a retainer, but not a secretarial auditor, can you do the valuation? Third one is, should be permitted. There's no contractual. He's only doing the assignments on a case-to-case basis. This is very peculiar for a company secretary. Can you just elaborate these three: secretarial auditor, retainership, and even services?
Yeah, I think third one you only answered. In retainership also, I don't see any conflict being there. I mean, subject to the fact what kind of retainership, normal filings, compliance filings engagement, I don't see any conflict with valuation. And secretarial audit, I'm not very sure in secretarial audit from the company secretary ICSI restrictions, if there is any restrictions of taking up the secretarial audit with independence or not, that needs to be checked. So subject to that, I think in other cases, there should not be any concern.
Maybe Shilpa, this being a very routine issue for us, can you just maybe participants can just throw their experience?
Yeah, first I will share my experience. I really wanted to check others' viewpoint when I got the assignment. I get assignments like to do secretarial work, also to do valuation also. That time I'll be in a clear fix what to do. Then when I checked out, many of my friends said, no, it's a clear case of conflict of interest. But one way to judge yourself is whether I'm doing a pure company secretary work, wherein I'm convening a board meeting, shareholders meeting, and doing filings, wherein the value of the company is not going to change at all by whatever services I'm rendering that way. Or I'm also giving a consultancy wherein I'm telling them what kind of instrument to use, what kind of structuring, consulting, pure consulting, financial consulting, whatever experience I have. So the value of the company is going to change or may change depending upon my advice. Okay, a pure consultancy or a pure company secretary, board meeting, shareholders form filing, wherein the value of the firm is not changing at all, wherein my advice, is not going to matter at all, seriously, in terms of valuation. So this, one of my friends suggested, this is the real, easy to justify. How we are going to prove when someone questions us is time will say. I will request other participants to throw their, share their experience. Otherwise, just by, putting my DSC on a particular form filing, shouldn't make, take as a conflict of interest.
Shilpa, actually, section 247 2D of Companies Act clearly says, not undertake valuation of assets in which he has a direct or indirect interest or becomes so interested at any time during the period of 3 years prior to his appointment as valuer or 3 years after the valuation of assets was conducted. So if you are interested in that firm, that company, I think the valuation assignment should not be taken. That's what
there's actually direct interest refers to shareholding in the company.
Yes.
So you can't buy shares in that company or either directly or indirectly for a period of 3 years prior or 3 years after. However, Nataraj, what Chinmay's point was very valid. Suppose you want to issue an audit report on that company. If you have done a valuation for that company, you have done something which is of the nature of a management function. Okay. And therefore, there is a potential conflict of interest because you cannot issue an audit report on something you have done yourself. Okay. So, which is why in audits, we say that an auditor cannot comment on, if he has prepared the books of account, he cannot audit it. So if he has issued a valuation report, he cannot audit it. So he cannot be the auditor. That I think is the conflict of interest. Similarly, with the company secretary, if you're issuing a secretarial audit report, my belief is that you may be conflicted based upon secretarial standards. And
yes,
the
Abraham,
point which
actually,
Chinmay,
you just touched upon one more point where if it is not a compliance related issue, let's say I'm doing an accounting work and I'm not certifying the accounts. Can I do the valuation, or can my partner
yes, you
do the
can.
valuation?
I think that you can do it because if you're doing, let's say, accounting work for the company, what
Yeah.
you have is more information. Okay. You're not issuing an audit report there. You should,
Okay.
however, disclose. The key to this is disclosure. You disclose the
yes.
contract which you have for whatever retainership you have, you disclose that in your valuation report. Now, then after that, it is the judgment of the user of the report as to whether you're conflicted or not. You state what is the amount of fees, the type of work which you're doing, and then leave it to their judgment. Okay, in your viewpoint, you're not conflicted.
Abraham, you're right. The key here is whether you are in the management function. That's the key word here. Because if you are in the management function, you have the ability to distort or be biased with respect to the values or the projections or the financial numbers. As long as you're not doing that function, you're absolutely not debarred officially. That's why if you see even in the law, they clearly they debar only the auditors. The auditors are actually like a management function because they're actually auditing those specific numbers. Probably that's the reason.
Right. So Shilpa, does this address adequately, or Chandrasekhar feels that there is something more which he needs?
Sir, I got it. I think now my conclusion is that secretary auditor cannot take a valuation, and retainership and others we can do it as a disclosure is required. However, any such assignments will become materially or some management function we need to avoid. So basically, wherever Shilpa, we have retainership agreements, we can go ahead. It is not in fact impact conflict. Only disclosure is required. That's what my I think what I got from the panelist.
Yes.
Thank you.
Yes.
So secretarial audit report will be for 3 years, right?
Yes, correct.
Okay.
One of the other question what I have received is whether panelists can share their experience, whether they are willing to provide valuation Excel to the client in case they are asking. Client is asking, I want to know the Excel calculations behind your report. This is a normal practice that we share a draft Word report. So whether Excel also can be shared in case client is he wants to.
Okay,
see.
let me give my perspective and then I'll just ask some of the. See, my issue is that in case I give that Excel report, because quite often I get the work done by my staff, there could potentially be some Excel errors. Okay, I don't want my Excel lying with somebody who's going to question it. Okay, so I mean, this is my just a very practical viewpoint. So therefore, my sense is that I will give whatever you want. I will even discuss the workings with you, but I'm not going to give you the Excel. Okay, so if you want to do a revalidation based on anything and you still find an error, then maybe I will reissue I will do that corrigendum like we discussed earlier. But however, Excel working, I am not keen on giving it. I know other people want to discuss and see whether they are right or wrong before they finalize the report. Okay, but I believe that's a way in which your report will never get finalized because there will always, when there are 3 people, let's say, especially when you have, let us say, KPMG on one side, PwC on the other side, and then you have, let us say, you on the third side. The 2 of them will never agree. KPMG, PwC will never agree. Okay, and therefore you get stuck in between. But management is also there on the 4th side. So therefore, it is never in your best interest to share your Excel workings with PwC, with KPMG, because they will find ways in which they will question everything, left, right, and center. Okay. Vikas, I think you probably agree with me on this, right?
Absolutely. Abraham, I keep saying valuation is an opinion or a recommendation. So I would use my Excel to do my, to draw my conclusion. I would never want to give an editable version of a report or a Excel to the client. It's as good as saying that you take my report, you draft whatever you want. So up to business plan, I'm fine. It's because it is their own numbers, it's their own stuff. But beyond that, when I'm doing my working of DCF, I'm doing my computation of discount rate and all, I definitely will not want to share it.
So how do you humbly refuse it with all due respects to client, and how do you say that?
If you ask me, I clearly have taken stance at all the places wherever it is my opinion. My deliverable is my opinion, and we don't give editable opinions.
Okay, another way in which I phrase it is that I say that working papers belong to me. My Excel is my working paper. What is due to you is the report. The final deliverable to you is the report. I will give you the report. That belongs to you. You can do whatever you want with the report. But the working paper belongs to me. And this is backed by law. Okay.
And in fact, Abraham, just to share one extreme situation, even in a court of arbitration, there was a request to share report, which was not meant for sharing with the court. It was done for others, and we refused to share it, saying that on grounds of confidentiality we are not obliged to share, and the court accepted our viewpoint.
Oh.
Right.
For Sheetal's question, how do we refuse? Another idea is, okay, in our case, we use a tool. It's not just an Excel sheet. It's a lot more things, few macros are there and many other things. So that's why anyway, we cannot share it. So, but you can also say like that, saying
we have a tool.
Just an Excel, it's a tool or something with which it comes. We can give the PDFs. If you want any changes for the draft, we can give a revised draft with what edits you are looking, but really can't share the tool.
Chinmay, on that extreme, we have found smart clients saying, okay, we have the tools and you give us the tool also.
No, that's a proprietary, no? It's a IP, right? So tool is a proprietary IP.
I actually share everything.
Yeah, because
I believe that assignment is them, it is their work. My working papers are not the basis of my capability and my ability to make an opinion. The moment I go above that, I feel that you take whatever you want. You cannot replicate my capability, because next time when you have to do it again, you have to use my capability. And it gives them more confidence. I mean, this is, of course, I'm not as experienced as Vikas and Chinmay in this aspect. I feel that it is client's property when I'm taking assignment with them. I do everything. I share my listing report as well as my working files. So
see, Ganesh, where I have seen, I'll share with you the other side picture. While what you're saying is right, we can, if you share it, what happens, I'll tell you. The other side, even if there are no errors in the model, the other side does not understand the full nuances of your working. They will randomly make one or two changes. They will get a conclusion and go ahead and communicate to the top management. This is the conclusion coming out of so-and-so's model.
But your report is fine, right? The answer is, as far as working papers are, it's like a working paper. What they're communicating, if they are communicated something differently, if it is differing from what I communicated in my report, because that's why I said in report, everything is captured in which is. My report, which is signed, is what I have put it on paper. So I'll give one, since you're asking again, there was a legal opinion I have given on a PF transaction, whether you can take money from reserves and surplus for a false investment. I prepared a legal opinion, I gave it. They had a long conversation with me, I explained to them. And they said, okay, give us a report, we'll make minor changes. And in the minor changes, they fundamentally changed the critical one line, which actually changes the meaning. So I said, my signed report is my signed report. No matter what you want to do, doesn't matter to me. If you are going ahead with it, this is my report. I feel working papers are to be given because end of the day, it helps them to look at what they get convinced. Second, they also get a better perspective. The people who can't get convinced, anyhow, they are not the best of the clients next time. They will not come to us if they're not convinced this time. So I feel that giving reports is a better way. I mean, my personal choice than not giving.
Okay, right. So, yeah. So any more questions, Shilpa? Because we've reached 9:30.
Yeah, just one important thing, DLOM and DLOC. Okay, how can we rely on, what is the backup documents as a valuer one should keep ready? Whether any indicative guidelines from ICI, any research paper, anything we can bank on, how do we take it? How do we justify it? How to value and how to justify it? DLOC.
Okay, so discount for lack of control, I think that you do have market studies which you can use based upon data. Discount for lack of marketability also is backed by that really. There are also third-party studies which are done by, let us say, the Big Four, which can be relied on. I think that you can rely on the third-party information for the DLOM and the DLOC is my viewpoint. But let me ask Vikas, quickly, can you just respond to this?
Sure. There are two corroboration points, like how you rightly said. We have not come across anywhere metric given in a regulatory guidelines, except only one. The erstwhile CCI guideline used to have the track of for illiquidity discount for unlisted shares 15% discount. Okay, that was the only guideline. After that, it is the studies which have come in from all the various professional firms. Second, I always keep a tab on the discount rate. See, you are talking about there is a time period for which you are saying there is no marketability. So 1 year, 2 year. So broadly, it corroborates with my 1 year of return or 2 years of return. I try to keep that as one of the benchmark. Other than that, there will be no tangible benchmark otherwise.
Okay. Next question, Shilpa.
When there are multiple rounds of funding, especially in case startups, okay, and the frequency is say 4 to 6 months, from one round of funding to another round of funding, and same investors or new investors are paying higher than the earlier rounds of investment price. How are these situations handled, especially when the existing performance in a startup scenario is not matching to whatever they had expected or shown earlier? So how do we take up those startup next rounds of investment? On one side, when you want to continue with your valuation, because whatever you have projected also has not been achieved, and promoter will not be willing to give at the same valuation.
The question is that how do we issue valuation reports at constantly increasing valuations?
Especially say 1 month, 2 month gap.
Yeah, with short gaps. So this, I think that, see, typically what you have in a business plan when you're having a startup enterprise is that there are certain metrics which you hope to beat. So for instance, let us say one of the metrics is that based upon my initial round of funding, I will do a proof of concept. Next is based upon the next round of funding, I will have certain client acquisition. And then based upon the next round of funding, there will be a certain metric which will be achieved. I will build up the organization, I will hire management, I will approach, I will have multiple channels. So based upon this, you do have increases in the valuation of a company. Okay. And if this has actually happened, if you are progressively taking it up in line with the in line with the path which has been clearly defined, it is then a matter of your judgment. I mean, you would have outlined it earlier itself based upon management's perspective as to this is the path would have been outlined. And if you're going along that path, well and good. I think that you probably will be able to do it in that manner. Again, it's a matter of judgment for the valuer as to whether he wants to issue the report as those increasing valuations or not. Okay.
Actually, there is nothing, because 1 or 2 months, no magic is going to happen. It's just that, he didn't need funds and investor wants to come in. So promoter has a chance to increase the valuation. It's all negotiated basically.
So it's backed up by a market valuation. Okay. See, I'm just trying to give short answers to try and keep it within time, because otherwise this can be discussed a lot. See, it is a negotiated market price where he gets the investor to invest money at a particular price point. So if he is going to do that, now what you're doing is that you're then saying that based upon their perspective, this is the valuation which they want. I would believe that's the way in which you would handle it. Okay. But you want to discuss it further, in which case we'll take a bit more of time. If you want to, we can do it. Then we'll bring in all the.
I'll give a one-liner, Abraham, since Shilpa is holding up there, not moving from her position. Shilpa,
this is a very practical problem everyone is facing.
See, the answer is this. There's no way one would believe that 3-4 months, numbers jump, numbers don't move. The valuation could change depending upon the liquidation preferences, certain rights that you are giving for the next round, third round. So that could be the basis in which valuation might be increasing. So suppose if I have invested at $400 million, next round I'm giving for $800 million. But the next round investors have a higher liquidation preferences where actually they get everything beforehand. There's no reason why it should not be valued at $800 million, because it's as good as actually they have full rights before anything. That's the reason. And those details, we don't get it as a commoners when we are looking at it. That could be one reason valuation is moving. Second thing is, if I were to justify what Abraham is stating right now, if I were to make a projections for 5 years or 3 years, and I have defined these projections, and I said in absolute normality with these various milestones, the valuation is say $1 billion. So then I say that I would not value $1 billion. I would value only $300 million. After you reach the first milestone out of say 5 milestones, then the valuation, I know that you reach this milestone. Therefore, instead of 200 million, it should have been $300 million. If I would have done those estimates, then it was easier to justify it. Otherwise, there is no reason for any projections to change every 3-4 months at any cost. And that.
So let me give you an example, Shilpa. There is one company which is, let us say, valued at $150 million. Okay. But they are likely to sign a $3 billion contract with the government. Okay. The moment they sign that $3 billion contract with the government, the valuation has changed. Okay. So this is the one factor which changes the valuation. So it's like this. No? I mean,
Sorry.
Sir,
Abraham, just to summarize on only one point, to build a case for people to accept valuations on that and to get a regulatory support also. See, AIF, which is blessed by SEBI, itself has a mandatory requirement for revaluation every 6 months. That itself tells you that valuations can be done every 6 months. They need an update valuation every 6 months. The more you are at the early stage where you are creating value in a shorter period of time, you can revalue it as many times as you want. As every milestone is getting achieved, the valuation milestone is like how Abraham said, just now one bigger contract comes, by default, you will have a valuation grant. And as I said, to get a support, a corroborative support for my judgment, AIF supported by SEBI itself mandates a requirement of a frequent valuation. So you can do a revaluation every quarterly, every half yearly.
Sir, I have a question here.
Sir,
I have a question here, sir. Yeah. Now, if the valuation is increasing, where is the requirement for the valuation report? I mean, if the second round of funding is made at a higher valuation than the first round, where is the requirement for a valuation report? If it is a management requirement, for the purpose of negotiation, then of course we will put the caveats. If it's but there are no regulatory requirements for me to get a new valuation report.
Uttam, short answer to that, if the investments are coming in from foreign investors, FEMA may require it, companies act.
Fair enough, sir. No, sir, it's a higher valuation, sir. It's a higher valuation. If the valuation was happening at a lower price, then it is agreeable. This is a higher valuation. FEMA would not require it.
Sorry. Just I know from a time point of view, I'm being a little fast. Shilpa is looking at it. Even from a higher valuation, you are saying it is higher than the earlier round.
Yes, sir.
Correct? But
yes,
the earlier round may not be the fair valuation of today.
So, Uttam, let me give you an example for both you and Kaushik. We had one situation where the promoter of an NBFC was coming in with his own capital, 5 crores he had invested. Then he got the RBI license, he started off work. Now his next round was friends and family, which is, let us say, 25 crores valuation. Okay, so he brought in somebody at that 25 crores valuation. And the next round after that is others. Now nothing has changed, right? He has just got his investment in, his own investment in, he has started work, he's got the RBI license, that increased the valuation a little bit. Then friends and family come in, based upon their past track record, they have invested money. And then the next round is going to an external investor to build his asset book. Okay, so here again, the valuation has gone up to, let us say, 100 crores. So there's nothing wrong, I believe, in this, because this is as per a plan of action which is implementing. So valuation has changed from 5 crores to 25 crores to 100 crores.
Agreed, sir. But now in the third round of investment, which has happened at a higher valuation, where is the requirement for the valuation report? Valuation is fine. I mean, why should we justify a transaction which is happening at a value higher than the fair market value? If we are talking from an income tax perspective, that tax implication will be there. Definitely a tax implication will be there, because earlier, if we had said that the earlier valuation is a fair value, and if we are transacting at a value which is higher than the fair value without any changes in circumstances, if changes in circumstances, then it's a different question. If there are no changes in the circumstances, then the company is not barred from accepting the investment, but it has to pay the taxes. However, if that company is registered as a startup, then there is no requirement for it to pay taxes as well. Startup with the IBB, with the
EIPP.
Yeah.
Right.
So now, as a valuer, I mean, if the management is asking me for a valuation report, I'll have to basically tell them that this valuation is not required. From a tax perspective, if they want to save the taxes and they want a valuation report, in such a circumstance, I will basically take representation from the management that these are the circumstances because of which the valuation has changed. And on the basis of those representations, I'll basically, if I feel that the representations are justifiable, I'll issue a higher valuation.
Mm-hmm. Right.
Just to add there again, even in that situation, the IBBA registered valuer's valuation is not accepted by income tax authorities. It should be from a merchant banker because it is always DCF. And even in that situation, for the purpose of Companies Act, the valuation is not required. For the purpose of Income Tax Act, to ensure that the companies do not suffer tax at 5627B, they should go for merchant banker and not a registered valuer. So this is an anomaly there. Again, mandatorily, there is no requirement like Uttam ji is telling to issue a valuation report from a registered valuer from IBB.
Right.
The period is
Okay.
less than 6 months.
Okay.
Just
So
a
I think
small word of,
yeah.
just a small word of caution to young professionals. Whatever this DIPP exemption, startup registration, that is slightly different from angel tax exemption, what Uttam is referring to under section 56. Otherwise, some professionals will believe that, once you get DIPP registration, you are eligible for this angel tax exemption under section 56. That is different.
Yeah,
This is
you have
different.
to specifically apply for it.
Specifically apply for it. Yeah, just a small word for young professionals.
Okay, so I think we're done. Shilpa, in the interest of time, because we're also losing some of our participants, can we
just one convertible note option can be, just one line answer, in case of issue of convertible notes or conversion of convertible notes, whether valuation is required. Issue and conversion. Just this is the last question we are taking.
Okay, so I think that let's just address it straight under section 62. If the terms of the conversion are defined upfront, then you may not need a valuation at the point of time of conversion. However, typically a convertible note does not define the terms of conversion. So therefore, at the point of time when there is a conversion taking place, you need to have a valuation report. This is my perspective here. Okay.
Yeah, rightly said, banker is asking at the time of conversion. So banker's logic is correct.
Right.
Yeah.
Okay,
thanks.
so I think that there are a number of topics which we may not have covered, and we are sorry for it. We have tried to do the best that we could. In case there are further questions, you can always address it to any of us. All of us, we are all in the same group, so you can address us directly. Chinmay or Vikas or Ganesh or Shilpa also will answer a lot of questions, or myself. So please feel free to do it. Back to you, Shilpa.
Can I request Sheetal to convey vote of thanks? Sheetal?
Thank you for the opportunity, Shilpa. I thank BVA. I thank all the panelists who discussed all the questions at length and clarified our doubts. Thank you very much. And I look for it. We all look for it again for such kind of insightful sessions.
Thank you, Sheetal. Thank you, Vikas, for having spent the time, and Ganesh for having brought those perspectives to us, and also all our participants for having been so interactive with us. Thank you so much.
Abraham sir, my request is, maybe we should have more of such sessions. Maybe once in a quarter, we have to have one such deliberation session for discussing all amongst ourselves. I think it has been a wonderful session. Thank you very much,
We'll do that,
gentlemen.
and we'll probably make you one of the panelists next time.
Oh my God, I have to reach there. Thank you, sir. Thank you very much, sir. Have a good weekend. Bye-bye.
Anyone interested in breakout rooms now?
No, at this stage.
Actually, even I'm also heading for another meeting right now.
Okay. Okay, thanks everyone. Thanks to all the participants.
Pleasure interacting with you all. Very nice. Thanks for panelists. I think it was good to discuss with your views.
Thank you, everyone.
Thank you.
Okay, thanks all. Happy weekend.